every fund manager, nobody is complaining, everybody is preparing for a Christmas holiday. Some are buying caps, some are buying cakes. Pankaj Tibrewal, should we start with markets or how are you planning to spend your Christmas?
I think we all are absorbed in markets, so it's worthwhile to devote some time and discussion today morning for markets. And I think markets are at a very interesting juncture, Nikunj. Um, we had a great run in the last 18 months. Uh, and I think medium term our outlook on the markets remains constructive, led by the new profit cycle, led by the policies, and led by the revival in the investment cycle. However, in the near term, we are cautious on the markets. And let's divide our discussion into two parts, one on the fundamental basis, and the second is on the flow basis. On the fundamental side, I think what supported the market for the last 4, 5 quarters was the positive earnings surprise. And we were early into the cycle where multiples expanded, positive earnings surprises were there, and combination of both led to strong rally in the market. But from the third quarter onwards, our thought is that the earnings upgrade cycle is probably behind us. We may pause it for next couple of quarters. And the reasons are four. Uh, First is the commodity pricing hitting the gross margins and operating margins of the company. Second, the tailwinds which we saw in terms of lower wage, lower marketing spend, and lower traveling cost all are behind us. And don't forget, last year in the third and fourth quarter, corporate India had the best ever margins. So we would have a difficulty on the margin side for corporate India. And our sense is that there is a slightly lower probability now that the third and fourth quarter may see some earnings downgrade rather than an upgrade. So the fundamental reason which supported the market for a long time probably looks to be behind us. And for the next couple of quarters, we should brace ourselves for a pause in the earnings upgrade cycle. The second part coming on the flow and more on the technical side, I think in our view, the best of the market breadth is behind us. And there are many indicators which are started to show that the breadth of the market will narrow down as we move into next 12 to 18 months. Don't forget, in 2003 to 2008, we had a great run from 2003 to 2005 end, where everything participated. But from 2005 end till 2008, market became extremely selective and polarized. And if you were not invested in those 4, 5 sectors, you probably underperformed. I think that phase of the market is looking to start now, where the best of the breadth may be behind us and market may become extremely polarized, and the dispersion between winners and losers could be quite starking. The second point is that if you look at in the US, clearly the junk bond yield minus the 10-year bond yield out there is at a 1-year high. That means that the beta chase liquidity driven rally, which we were witnessing for the last 18 months, could be behind us. And we need to be more careful as we navigate the higher interest rate cycle in 2022. So I think the easy money is behind us, and we all should moderate our return expectations. And for the next 12 to 18 months, in our view, it will be a stock pickers market. Markets will get extremely polarized and narrow in our view. So in summary, in the near term, we should be a bit careful in navigating this market. From a medium term perspective, we remain positive because the new profit cycle is for real. Government support is there, and investment cycle is reviving after a decade.
Okay, great points. Now let's understand the other aspect, and I'm going to be devil's advocate. When you say that we could be in for a earnings pause, let me come back by saying that the capex has just about started. The real benefit of capacity expansion would kick in, and globally also energy and commodity prices are no longer at October high. Whether it is steel or cocoa, or whether it is lumber or timber, all commodity prices have already come off by 5 to 20%, 25% from the highs.
Yeah, Nikunj, you have a point, but don't forget that markets always focus on incremental change. What market is pricing today is a decent growth for the next 2 years. Now it will boil down to the actual delivery. Let me give you some anecdotes. It may be early indicators, but we need to be careful. We did a lot of channel checks at the ground level, and November doesn't seem to be a great month for demand across many sectors. Cement saw a decline in demand. Many of the dealers told us that the demand for consumer durables were not good. After the price hike, we saw a slowdown in demand across many sectors. It may be a coincidence because this time Diwali was in November, so you lost virtually 10 to 12 days in a month. But we have to watch out in December and January how the demand trends shape up. So we need to be careful on that front. On the margins, I think one is the commodity price pressures. The second is that in the month of September, October, when things were just going berserk on the commodity side, corporates, if they wanted 1 ton, they ordered 2 tons. So they actually over ordered. And from there on, we have seen prices decline, whether it be iron ore, coking coal, and as many of the commodities you mentioned. And there is an outside probability that we may be staring at inventory losses in this quarter and early part of next quarter. So when I look at the margin trajectory, it's very difficult to kind of beat the margin trajectory which we saw in the third and fourth quarter of last year. That's one. The second point which I wanted to highlight is that in the first half financials, one trend which we saw was that 80% of the NSE 500 companies ex-financial saw a decline in the operating cash flows. Only 20% showed an increase in year-on-year cash flows. And I think cash flow, as we have been mentioning, top line is vanity, bottom line is sanity, and cash in bank is reality. So if cash flows don't come up again, markets may see selective derating in many of these sectors where P's are very high, but cash flows are not supportive. It may be a temporary phenomena, but we need to watch out on the cash flow front for corporate India as well as we navigate into the second half. So headline numbers may look good, but the earnings upgrade cycle, which is more important, I think should take a pause. And that's where our thought is coming from a fundamental side, that markets either may see time correction or may see value correction or both as we move into the second half and beyond.
There is one more variable. Nearly 40% of your total earnings are global in nature.
Absolutely.
And there is a weak rupee tailwind which suddenly is there for IT pharma. And looking at the inflation dynamics, I'm assuming rupee will remain weak because Reserve Bank of India cannot control inflation and rupee and interest rates. It does not happen this way. If there is a weak rupee, what happens to that 1/3 or 35% of the nifty global linked sectors?
A very interesting point, Nikuj. So let's dissect the September quarter numbers. So NSE 500 companies on an aggregate basis reported 250,000 crore of profits. This is the highest ever profit in a quarter delivered by corporate India. But if you look at the composition of that profit, 80% of that profit came from metals and mining, oil and gas, and banking. And the rest 20% came from all the other sectors. Going forward, I think we have seen decline in commodity pricing. So the earnings of the metal and mining companies were the best in September quarter. From here on, we may see a decline only in December and March quarter. On the oil and gas side, we have seen decline in Brent crude. So it may hit on the inventory side, and we may see inventory losses by most of the oil marketing companies. Banking is one which is well supported. NIMs are well supported. Loan growth has started picking up. Asset quality is far better than what people envisaged a year before. So I think when you combine the entire corporate profitability, I think you will get some operating leverage because of the top line growth. But on the margin side, you may have a problem. So I think the best you may repeat September quarter numbers, but to circumpass that will be a challenge in our view because the composition of the earning is something more cyclical in nature. What may support you is clearly the IT side on a weaker rupee. Clearly, some of the export-oriented units like pharma, maybe specialty chemicals to a bit, but the rest of the sectors which in the past have been contributing to earnings growth may see some kind of a headwind.
Good morning, Pankaj. If one reads a lot of what you have said in the recent past, and it's something that you keep saying, right? That pick themes that last for 2 to 4 years, compounding is the eighth wonder. I take all of that. But you've also always spoken with great pride about being an early picker when it comes to specialty chemicals. You just alluded to that as well. What is the next big theme? What can be the next specialty chemical theme that will give you the kind of returns going forward?
So two themes, Neta, where we are positive on, and we believe that that's a multi-year cycle. One is the industrial and cap goods. We are minority in that thought process for a year now, but we believe that early signs are emerging, which gives us a confidence that the cycle is turning up. What are those signs? One, the corporate India balance sheet is in the best shape in the last 2 decades. And most of the corporates we are interacting with, they are suggesting us that we are looking to redeploy the cash flows back into the business, whether it be a cement guy, whether it be a steel guy, whether it be the entire ecosystem on the EV side and renewable power side. Everybody is looking for growth and the balance sheets are supportive. Interest rates are lower. The third point is on the PLI and the China Plus strategy. This thought is no longer in theory now. We are seeing company after company, sector after sector, talking us about the supply chain diversion from China to India. And we are seeing that in engineering, capital goods, home improvement like tiles, where India is becoming a dominant player. So I think the entire cap goods and the industrial basket is looking extremely good. And we believe that that's a 3-4 year kind of a cycle. And we have a large overweight across our portfolios on this theme. What we are liking in this theme is first the early cycle plays, like the abrasives, the bearings and stuff which goes into manufacturing. And the second is the late cycle plays. The second theme which we believe is again on a very strong wicket is the entire real estate cycle, where we are more positive on the home improvement side, because on a structural basis, developers don't generate the return on equity which we desire as investors. And hence, we look at one step down, where we believe the entire home improvement sector, whether it be tiles, plywood, mattress, wires and cables, cement, everything is looking very good. And I think there the demand surprise could be very positive, and the real estate cycle is turning after 7-8 years. So these two themes are very, very important themes which are forming a significant part of our portfolio. Another theme is we have to be extremely selective about the digitalization theme. We agree that the value migration is happening from brick and mortar to digital companies, but which one of them will be successful is something we need to see over a period of time. But this is one space we are analyzing very closely and looking at every company which is coming for listing.
So then, taking that point forward, you're looking very closely at the companies that are coming for listing. If you look at the recent listings, they're down from their highs. Whether it is a Zomato, whether it is a Policy Bazaar, whether it is also Nike. It rallied yesterday, but it is off the highs. And next year, you'll of course have the next wave of digital IPOs, from an Ola to an Oyo to a Farmeasy to a Delivery, etc. The froth in the IPO market. Your views on that?
Yeah, so we have been extremely selective in investing in the IPO companies. We acknowledge the fact that many of the companies are coming at very high valuation. Though they may be quality businesses, but to make money from here on will be very difficult because the starting point is not correct, and we are avoiding them. And some of the names you mentioned, we clearly avoided them because in our valuation metrics they were not, fitting in. So we remain extremely selective, and history suggests if you look at the last 20 years, only 8% of the IPOs are trading above their issue price or have made wealth for the investors. So it's a typical cycle where there's greed on the street. Market is trying to lap up every business, listed them at a premium. But the real test will be how many of these companies create wealth over the next 3 years after their listing. And I think history suggests that that percentage is extremely low. So we need to be extremely careful on this IPO frenzy which is going on in the markets today. Think about any company, any banker. They may not be fools that they price their issue so low that on the listing it makes you 100%. So on a 7-day window, you are making 50, 80, 100%. That easy money, I think, will be difficult in times to come. And some of the IPOs which got listed recently are showing signs of that. So I think we have been extremely selective in IPO investing and going forward.
Pankaj, I think the reason Nayantara was trying to ask you about IPOs was because most of these have already seen a fair amount of correction from their listing pops. I mean, for instance, we were just looking at a Paytm and a Nykaa itself. Now that the anchor book has been opening, and that paves the way for the PE guys to make an exit. I mean, look at Paytm. We all know the debacle that it turned out to be on listing. And even from those levels, yesterday itself, it was down 10%. Even Nykaa has been down about 20 to 25% from the listing pop. So with the anchor investors exiting and the stock easing off a little bit, would you not relook at some of these names?
We will definitely relook, and we are relooking which are the businesses which will become larger in size in times to come. And at the appropriate price, we'll make our calls. But today, we think that the valuations are not in our favor in most of these companies. And probably we would be on the sidelines and watching them out. Maybe the listing price may not have been correct, which probably means that even if you correct 20-25%, doesn't make too much of a sense right now. So we'll wait and watch on the sidelines and evaluate on its merit. Don't forget that many of these companies have still not delivered few quarters of delivery on earnings side. It will be really important that how earnings are delivered as we move forward. So based on execution, we'll take a call and we will be extremely selective in our approach.
Sure, get that point. So we've pretty much got your buy as well as hold list. What I want to understand, Pankaj, is going forward, what's on your sell list?
So clearly companies on the low quality matrix, and one data point which I think which is very important for all your viewers is that after December 2020, for the first time in the last 30 days, we have seen a migration from low quality stock back to high quality stocks. This happened in 2011. This happened in June of 2015. This happened in April of 2018. And this migration again suggests that market may become very selective, and there could be either a value-wise or time-wise correction in the market on the overall basis. So I think clearly one pocket is where we are not confident on the business model, or the return on equity or capital employed structurally is much lower than the cost of equity, which means they will destroy value over a period of time. The promoter pedigree is not great. So try to avoid that pocket. The another pocket is where valuations are skyrocketing. The best of the expectations are priced in. And we believe it will be difficult from here on to see multiple expansion. And earnings delivery will become extremely important. The holdings are consolidated, and we are trying to avoid that pocket. There's a middle funnel, which looks to be reasonably valued. And there our focus is to select the best businesses out there. So these two pockets will be clearly avoids for us, the low quality and the very high valuation consolidated holding PE stocks. And the middle funnel is something which we are looking at.
All right, Pankaj, I appreciate your time. You've been very generous with your time this year. Every time we've requested for an interview, you've been accommodating that. So on behalf of everyone from ET Now, thank you for that and have a wonderful year ahead.
Thanks.